Right now, millions of Americans are asking the same question. Is the US economy actually getting better, or are we just being told that it is? Prices are still high, rent feels impossible, jobs feel uncertain, and yet headlines keep saying the economy is strong. So what is really going on behind the numbers? In today's video, I'm going to break down the real situation of the US economy in a clear, honest, and simple way, without hype, without fear-mongering, and without confusing language. This is not just about charts and statistics. This is about real life, real people, and real money. If you live in the US, invest in the US, or simply want to understand where the world's biggest economy is heading, this video is for you. Before we go any further, if you want clear and honest economic updates like this, make sure to like this video and subscribe to the channel. This is the US Report, and here we focus on facts, context, and long-term thinking, not clickbait. Subscribing really helps the channel grow and make sure you don't miss future updates, so take 1 second and hit that button now. Now let's talk about the big picture. As we move through 2026, the US economy is not collapsing, but it is also not booming. It is moving forward slowly, carefully, and with a lot of internal pressure. On paper, economic growth is still positive. The country is producing more goods and services than last year, businesses are still operating, and consumers are still spending. But underneath that surface, the story becomes much more complicated. Growth is uneven, stress is rising for average households, and the gap between those who are doing well and those who are struggling is becoming harder to ignore. One of the most important things to understand is that today's US economy is not moving in one direction for everyone. For higher income households and asset owners, things still look relatively strong. Stock markets, real estate in certain areas, and high-skilled jobs continue to provide stability and wealth. But for middle income and lower income Americans, daily life feels much tighter. Groceries, rent, insurance, healthcare, and utilities are still expensive, and wages have not fully caught up with the cost of living. This is why many people feel disconnected from positive economic headlines. The economy may be growing, but not everyone is feeling that growth. Let's talk about jobs, because this is where most people feel the economy directly. Unemployment in the US is still relatively low compared to historical standards. That sounds like good news, and in many ways it is. Most people who want a job can still find one. However, the quality of jobs has changed. High-paying, stable positions are harder to find, while part-time, contract, and gig-based work has increased. Many workers are holding multiple jobs just to maintain the same lifestyle they had a few years ago. At the same time, industries like technology, media, and some corporate sectors have gone through layoffs and hiring freezes, creating uncertainty even for skilled professionals. Another major factor reshaping the job market is automation and artificial intelligence. Companies are investing heavily in AI to reduce costs and improve productivity. While this boosts efficiency and profits, it also means fewer roles in certain areas. New jobs are being created, but they often require different skills, leaving many workers stuck in transition. This creates anxiety even for people who are currently employed because job security no longer feels guaranteed. Now let's talk about inflation, because this is where frustration really builds. Inflation is lower than it was at its peak a few years ago, but that does not mean prices have gone back down. Inflation slowing simply means prices are rising more slowly, not that they are falling. For most Americans, the cost of essentials is still much higher than it used to be. Rent remains elevated in many cities. Food prices are still painful. Electricity, insurance, and healthcare continue to eat into monthly budgets. This is why many households feel like they are running in place financially, working just as hard but not moving forward. The Federal Reserve plays a huge role in this story. Over the past few years, the Fed raised interest rates aggressively to fight inflation. Those higher rates made borrowing more expensive, which slowed down spending and cooled inflation, but they also created new problems. Mortgages became more expensive, making home ownership harder. Car loans and credit card interest rates increased, putting pressure on consumers. Small businesses faced higher financing costs, slowing expansion and hiring. Recently, the Fed has started to ease rates slightly, but it is moving cautiously. Policymakers are trying to balance inflation control with economic growth, and that is a very difficult line to walk. Housing deserves special attention because it sits at the center of the American dream. The housing market is still under serious strain. Home prices remain high, and even though mortgage rates have come down a bit, they are still much higher than what buyers were used to in the past decade. This combination keeps many first-time buyers locked out of the market. Renters are also under pressure, as rental supply has not fully caught up with demand in many regions. Housing affordability is one of the biggest long-term risks to economic stability, especially for younger generations. When we look at consumer spending, the story becomes even more interesting. Americans are still spending money, but the way they spend has changed. More spending is happening on essentials and less on discretionary items. Credit card usage has increased and household debt levels are rising. This tells us that people are maintaining their lifestyles, but often by borrowing more. That is sustainable in the short term, but risky in the long term if wages do not grow faster or if the job market weakens. Manufacturing and industrial activity also show signs of stress. While the U.S. has invested heavily in domestic manufacturing and supply chain security, production costs remain high. Global competition, trade tensions, and tariffs have made it harder for American manufacturers to stay competitive. Some factories are expanding, especially in strategic industries like semiconductors and energy, but many traditional manufacturing areas are still struggling. This has real consequences for blue-collar workers and regional economies. One of the clearest trends in today's economy is inequality. Wealth is increasingly concentrated among those who own assets, such as stocks, businesses, and real estate. These assets have generally performed well, even during periods of economic stress. Meanwhile, people who rely primarily on wages are more exposed to inflation and job instability. This creates a growing divide in economic experience. Two people can live in the same country, see the same headlines, and yet experience completely different realities. This gap also fuels political tension and social frustration. So where does all of this leave us? The U.S. economy in 2026 is best described as resilient but strained. It has avoided a deep recession, which many feared, but it has not returned to the comfort and confidence of the pre-pandemic era. Growth continues, but at a slower pace. Innovation, especially in technology and energy, offers long-term promise, but short-term challenges remain. Much depends on how inflation evolves, how the job market adapts to technological change, and how policymakers respond to mounting pressure from voters. Looking ahead, there are reasons for cautious optimism. Productivity gains from technology could support higher wages over time. Interest rates may continue to ease if inflation stays under control. Infrastructure and energy investments could create new jobs and strengthen the economy's foundation. At the same time, risks are real. High debt levels, geopolitical uncertainty, and social division could easily disrupt progress. This is a transition period, and transitions are rarely comfortable. As viewers of the U.S. report, the goal is not to panic or celebrate blindly, but to understand what is happening and why. Economic headlines are often misleading when taken alone. Only by looking at the full picture can we make better decisions, whether that's about careers, investments, or everyday spending. The economy is not just numbers on a screen, it is the sum of millions of personal stories playing out every single day. If you've watched this far, I'd really like to hear your perspective. Do you personally feel the economy is improving, or does it feel harder than before? Drop your thoughts in the comments, because your experiences add real value to this conversation. And if you think this video can help someone else understand what's really going on, share it with them. It helps the channel grow, and it helps spread informed discussion. Thanks for watching. This is the U.S. Report, and I'll see you in the next update.